You're with us here on a fresh new edition of Taking Stock. We are looking ahead at the week which is going to be in front of us. But to do that, we always look back at the 5 days of trading action. I mean, basically the first 5 days of 2019 and what that has meant for us. It's been a rocky and an edgy start to trading in 2019, absolutely no doubt about it. And we will tell you what you need to know and what you need to take forward as we come into the next week. I'm Prashant Nair. With me, as always, my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. What a week it's been. It's been all over the place. Started with the thin volumes as we entered the year, then the volumes picked up and absolutely topsy-turvy. But I think what it does tell us is that the market is still very, very range-bound. We'll actually get more on the markets, and we'll talk about a lot of those trends as we go forward. Joining in to take us through the week's market action and, of course, the road forward on the Dalal Street is Harsha Upadhyay, Chief Investment Officer, Equity at Kotak Mutual Fund. Okay, Harsha, we will just start our conversation in a second. Let's first recap the roller coaster ride that we have seen through this week. And Prashant, I think the one thing that really dominated attention and sentiment was this slowdown concern. Now, whether it is a local slowdown concern, car sales or auto sales were a big talking point, or a global slowdown concern because of the weak PMI numbers, manufacturing PMI numbers that we saw from China. So a lot of that continued to play out. The net result is that the index is sort of slightly lower for the week. The Bank Nifty is more or less flat, and the mid-caps haven't done too much either. But again, if you talk about sort of the themes within, on the domestic side, it was the auto sales data which was leading to a lot of the slowdown concerns and talk. The GST collections for the month gone by, December, they were also on the weaker side, falling to about 94,700 odd. So that kind of fueled more worries. And local talk was centering around this package. Perhaps that's going to come in on the rural side or the agri side, or even the concept of a universal basic income scheme. So these were, of course, a lot of the talk points. And if we boil this down to stock action, then some interesting themes and some interesting trends actually come out. I just want to pull up a few stocks to illustrate the point, to get a sense of the volatility that we've seen today. Eicher Motors, for instance, I mean, that stock is just finding no takers after the week numbers, almost 13% gone for the week. Other auto names like M&M, Maruti, they've all been on the weaker side as well. If you talk about the other area that was highly volatile, it was metals. Earlier half of the week, all about slowdown concerns, global concerns, etc. And the second half, with the CRR cut coming in on Friday in China, there was a big sharp rally coming through. For the week, of course, auto stocks are still down. Banks have seen some interesting buying. So Yes Bank, ICICI Bank, these were some of the key gainers. Bharti Infratel has been a big gainer. And of course, Jet Airways perhaps stands out as a stock with too many woes surrounding it, down again about 11-12% for the week. So that's some of the stock action, Prashant.
So let's look ahead, Surabhi, and let's look at what is going to matter when we come back next week. And I think the big one is essentially further cues on whether global growth is slowing down or it is not, because we've got some mixed kind of cues. I mean, even US, the ISM number that we got, it was weak, but then you had the car sales numbers, which were actually strong. But incrementally, I think one thing is clear, growth is slowing down. So let's begin looking at the factors. First up, global markets are now pricing in some kind of contraction as far as EPS growth is concerned. I mean, I actually found this number from Citi in a report about 24 hours ago. Citi is saying that global equities are essentially pricing in a 4% contraction in global EPS as of now. I mean, where levels are right now. They're saying, well, they're not pricing in a recession, I mean, even a profits recession, but they're already pricing in a 4% contraction in earnings per share. So that's essentially something to start with. I think global equities and the way they've been behaving, and there has been some talk at the margin that maybe we get some kind of a recession. I think generally speaking, it's a slowdown, not a recession. I think one should make that distinction very clear right at the outset. And all the data points to that. I mean, China, for example, we got PMI numbers going into contraction territory. But the services PMI number out of China was actually pretty buoyant. I mean, with the data which came out on Friday. Same thing with the US as well, as far as PMI is concerned. So it's mixed. It's not certainly showing a recession of any kind. There is a speech today, that is on Friday, from Jeremy Powell, which is, I think, going to set the tone for the next week. And I think the Fed chair's speech becomes very important now because of the market trying to gauge what the Fed's reaction is going to be to this slowdown. The general convention is that the Fed will hike lesser than what they thought, the markets thought 3 months ago, but they're still going to hike. But is that so? Will the Fed say that given the, we're taking stock of the market situation and we will take control? I mean, the quantitative tightening is not an autopilot. Will we hear something on those lines? If we do, it's going to be a big reaction as we come back next week to trade. If we do get that, expect dollar weakness. And I think generally speaking, broadly, people are expecting the dollar to be weak given that growth is not going to be where it is. If you get a deep growth scare, then the people run to the dollar. But if you get a slower growth, the dollar depreciates. If that is the case, it is helpful for emerging markets. Broadly speaking, it's helpful for emerging markets, but it doesn't necessarily have to be helpful for any one particular emerging market like in India. That depends on valuations, etc. Maybe this US-China trade thing comes back into focus because there is a meeting between officials, US and Chinese officials in Beijing next week with regards to trade. So we'll keep a track of that. The Apple earnings guidance cut, I think that will still continue to show up in various places. I think the impact has been disproportionate, asymmetric impact around the globe in various things, and I think that's not going to go away. India continues to do very well relative to global equities. India, apart from maybe Brazil, was one of the big global markets in 2018, which returned positively. And it continues to do very well relative to what the rest of the globe is doing. Big markets like the US are doing. And maybe one big reason for that is the domestic flow of money, which has been strong. Next week, we also get that. So, in December, we saw about a 30% drop. In November, we saw a 30% drop in inflows into domestic equity funds. I think the number in December is going to be important to track. And I think it remains important that that number stay healthy because globally things are pretty volatile as we stand. Surabhi.
Okay, well, on that note, let's kickstart this conversation. Harsha Upadhyay, Chief Investment Officer at Kotak Mutual Fund, is now joining in. Harsha, so it's a bit of a tentative start to the year. We can continue to sort of go over a lot of these slowdown concerns. But as you look at 2019, broad thoughts, do you think it'll be a better year for equities than 2018?
Surabhi, I think this year is going to be better than 2018, but I think in the first half of this year, the volatility could continue. There are several issues to contend with. Global growth slowdown fears are for real. I think that's going to dampen the sentiments across the globe. Then we have seen some of the domestic data which has disappointed. Although it is monthly data and you can't really predict a particular trend from that, but it's been disappointing whether you look at auto numbers or GST collections or some of those numbers. So, and Q3 is also likely to be lower in terms of earnings growth. There has been an impact of higher input costs at least for half of the quarter, and we have seen some slowdown due to the NBFC liquidity crunch that the country witnessed. Given all of this, we really, and also you have a political event which is coming up in the next couple of months. So given all that, the market is likely to remain quite volatile, at least for the next few months. And post that, assuming that there is a stable government in place, I think the policy momentum will come back, and also hopefully you will have a tailwind of lower raw material costs playing out from Q4 onwards, which should also help earnings growth expectations for financial year 20 as well. So all these factors point to fact that maybe second half is going to be a lot better than first half of 2019.
Okay. So, I mean, broadly, 2019 should be better for stocks than 2018, but H1 could be very volatile because of all the reasons you mentioned. Harsha, thanks very much for joining in. Just a quick question. What is, as a fund manager, how do you account for this sharp sell down in the US markets? And to what do you attribute the strength to? One convenient explanation is this wall of domestic money which domestic fund managers are sitting on, and that gets deployed. But for how long? If markets in the US continue to stay as the way they are, do you think it will finally start to show up here as well?
See, I don't think there is a one-to-one direct correlation between US markets or global markets to our markets. And definitely it's not on a daily basis. Yes, when the sentiments turn, when the market turn, there will be an impact across the globe, across geographies. But once the dust settles, then people will see which are the economies, even in a lower growth world, which are those economies or regions which will still grow at a faster pace. And then slowly the investments will pick up in those geographies. And that's what is likely to happen. And here we are talking about a slowdown in growth in global context. And if that happens, at least in the past, it has helped some of the countries like India, because the commodity prices usually remain low during that period. And India, being a commodity user rather than a producer of many of those commodities, usually gains in that period. And also we are seemingly moving towards a very benign scenario as well. So that should also help equities. So overall, I don't think one can just go by what's happening around the globe and extrapolate that to our markets on a daily or a weekly basis. But yes, I think overall the nervousness would be there on equity markets, at least for some time in the near term.
Okay. Now, since you are optimistic on the second half specifically, Harsha, what is the portfolio construct right now? I mean, what are your top overweight themes, and what do you think will be really the big idea of 2019?
We are betting on some of the sectors that are closely linked to economic activity, for example, engineering, capital goods, cement, etc. And these are the industries where we have already seen some amount of pickup in terms of either order flows or volume growth. I think that should sustain into next few quarters. And assuming that there is a stable government in place, then we should also see that momentum building up post that as well. And these are essentially the industries which have a large amount of excess capacity as such. And that should really flow into profitability if operating leverage plays up. We are also positive on financials, ex of NBFCs and PSU banks. We are focusing more on retail private sector banks and corporate private sector banks. And those are the names which would continue to get incremental market share. And we believe that that will drive stock market returns over the next few years as well. The areas where we are cautious or where we are avoiding, those are essentially global commodities, metals for example, and automobile, where we have been cautious for the last couple of quarters, and we believe that the volume growth slowdown that we are seeing is going to continue, and we believe that the valuations have not fully reflected the kind of slowdown that would come in earnings in that segment. Additionally, we are also negative on the telecom sector. We are completely avoiding that sector. So this is broadly where our overall portfolio is in terms of construction.
So you're betting on capital goods or the industrial capex, Harsha?
We are betting on capital goods and engineering, but within that we are once again selective. We are looking at companies which are closely linked to the short cycle private capex and some amount of government spend. We are not really betting on some of the capital goods or engineering companies which cater to long gestation projects or high ticket size projects, because there is unlikely to be a complete revival in investment cycle in that sense before elections or before the new government is sworn in and the policies are known. So to that extent, whatever we would see in terms of incremental capex that has to come from the current capital expenditure that's happening from the government side, whether it is central or state government, and also a little bit of private capex, which is more in the form of brownfield expansions rather than any new big capex that's coming in. So I think you'll have to be selective, and you'll have to leave out capital goods or engineering companies which cater to some of the troubled areas such as power generation, etc. And if you leave those out and selectively pick companies, I think there is money to be made.
So, I mean, so you're referring to, if I were to identify specific sectors, I mean, what, roads, metro, airports, I mean, broadly those areas? Companies which work in those fields?
Yeah, I mean, those are all continuing to see a good amount of execution, and that should continue even over the next few quarters, irrespective of what happens at the political front. And we are also seeing related benefits in some of the ancillary companies, not just the construction companies, but various other allied industries such as cement, capital goods, engineering, etc. And that's where I think the momentum will continue even going forward.
So since you are taking this bet on cyclicals for this year, Harsha, have you been pruning positions on consumption, or would you still look at buying some of these stocks that continue to be very richly valued?
Surabhi, for quite some time we have been cautious on the FMCG sector simply because of lack of margin of safety there. While the businesses have continued to remain quite strong, and the margins have also sustained, the volume growth has continued to be there in that industry. We are not so comfortable in terms of valuations, which have been at a historically high level compared to their own sectoral valuations as well as compared to the market. So we believe that's something that should be kept in mind if you are building position there, and we have been cautious on that segment for the last several months. And off late, we have also reduced our exposure to consumer durables and automobile, where we believe for the past 5-6 years there has been a consistent growth in volume, and that demand seems to be slowing down a bit, and there have been many reasons for that, and the recent NBFC liquidity crunch has also added to that, and the valuations have not fully corrected to the new reality in our mind. So those are the two areas where we have been negative.
Is there a so essentially you're saying there is a demand problem, right? It's not just, I mean, I'm talking about autos, Harsha. Not about availability
yes,
of funds,
autos,
etc.
There are, two issues as we see. There is a valuation issue as well. I don't think the valuations have corrected as much as what the decline in earnings growth would be. And secondly, there is a serious slowdown that's at least visible in terms of the monthly numbers in terms of volume growth.
So, I mean, autos is one area, but I mean, that's the poster boy of sort of discretionary consumption, right? So in that sense, what does it tell you about consumption demand in other sectors, or we can't really extrapolate?
It will be too early to extrapolate that trend across other categories, but definitely there seems to be some slowdown. We'll have to wait and see whether it affects all of the subsegments of discretionary consumption or not. On the consumer staple side, it's not a volume growth issue. It's more of just the valuation, which are at historically high levels.
Okay, Harsha, we'll wind it up for this chat on that note. Thank you very much for joining in. Appreciate your time on the show today. We need to take a very quick break. As we do that, listen to some market opinion that we gathered during the course of the week. When we come back, technicals with Ashwini Gujaral.
For the next 5 months until the elections, right, I think we're going to have excessively loose fiscal policy and attempts to loosen monetary and credit policy as well. And I think a price will be paid for that after the elections. There should be a slowdown in Indian economic growth simply because of the worsening external environment. This can be offset to some extent by a greater fiscal stimulus and credit stimulus, but that would lead to a more unbalanced economy.
Probability that in next 5 years you will have a earnings surge, like particularly coming. One is the consumption, second is the capex. So the earnings come from these two fundamentally large segments of this thing. So consumption side, nobody has ever disappointed. You know, here apart from the banks, which kind of had our corporate loan banks have disappointed, and that is also linked to the capex boom. So my sense is that the economy after 10 years finally somewhere along the line will see a surge in the capex, and that capex will lead to earnings growth for a lot of companies.
I think India is in a different cycle in some ways compared to China. So structural story is intact, and it had a deep cyclical problem because of the adjustments that had to be made during the period post-taper tantrum. And after that, we had demonetization, GST, and just very recently we had the NBFC problem. But the underlying fundamentals in terms of the policy mix, i.e. what is the real rate levels and what is the direction of broader fiscal policy, has been quite supportive.
Welcome back. You are watching Taking Stock. Joining us now is Ashwini Gujral. Let's talk technicals and take a look at the calls for next week. Ashwini, first of all, your assessment of how we are now finally poised, because it's been a very choppy week of trade. How are you looking at the start on Monday?
See, basically, this week you have doji on the bank nifty, which means we opened and closed at almost the same point. So not much movement on the overall index. Similarly, on the nifty, we opened around 11,000 and then came off to about 10,650. Again, it's a sort of a market that's marking time, and basically we've been in this 10,500, 11,000 type of band for a while. The only probably good news is that we are not breaking down, we are not behaving like the US market, etc. So that way, we are outperforming, but overall it's basically individual stocks, because it is you are not getting any sort of follow through either on the upside or the downside. So more such action should happen in the weeks to come as we go through result season. Chances are that almost till the elections, this 10K to 11K type of band is likely to sustain.
Okay, so basically very range bound. Ashwini, but any clear strong areas in the market and clear weak areas to stay away from?
Well, financials are the strongest, but in a range bound market, you don't make money buying the strong stuff, because by the time you can see it's strong, it tends to top out. So if I have to buy, say for Monday, I would like to buy the metal stocks, because they could have a 3 to 4 day rally given the Chinese news on rate cut, etc. So that way, if you want stuff that's going up, that's probably financials. But what could do well next week is probably metals. As shorts cover, you will get some upside there.
Okay, Ashwini, what about trades for the coming week?
The JSW Steel is a buy with a stop of 284, target of 298. Tata Steel is a buy with a stop of 484, target of 510. And CEAT is a buy with a stop of 1300, target of 1355.
Okay, Ashwini, thank you.